How tax efficient is your retirement portfolio? By Jennifer Lang, financialservices.com. Today we're going to be talking about strategies you can use to bridge the retirement income gap. Before we get started, I want to talk about the old wisdom versus the new wisdom. The old philosophy, retirement philosophy versus the new philosophy. The old wisdom is, you have this nest egg of 2, 3, or 4 million for retirement in one of your 400 series accounts, a 401k, for instance. And you draw down from that. Maybe 4% to cover your retirement expenses. Nowadays, a more realistic number is lowered a little bit to just 2.5% to 3%. And the concept of retirement income covering your essential needs is the prevailing philosophy. Using retirement income that's guaranteed or protected to cover some of your essential needs in retirement is the new line of thinking. Today, I'm going to talk about if you have a gap in retirement, your retirement income gap, how we can plug it or potentially plug it with an indexed universal life policy. First, let's talk about risks in retirement. Here are some of the main ones. Of course, there are many more, but here are the main ones. Longevity. People are living longer, and because of that, after they retire, they have so many years left into retirement. It used to be 10 years after you retire. Now, it's more like 30 to 40 years of retirement. You want to have a retirement income that covers your essential needs, because you're living longer. Another risk is inflation. Inflation historically is just under 3%, and so the value of products today will more than likely be higher in the future. Fundamentally, the cost of products today will increase in the future. Then, there's market volatility. This is a big one. When we're pulling from that nest egg, what happens if you retire in a bear market versus a bull market? As we know, sequence of returns can definitely jeopardize your retirement. Being able to withdraw retirement funds for a longer period of time puts your nest egg in jeopardy of running out of funds, depending on when you retire and where the market is. Wouldn't it be nice to have an income that's protected from stock market volatility? Next are taxes. We don't know where taxes are going, but currently, if you make over a certain amount, your taxes could go up. And let's not forget estate planning. Taxes can go up in the future, in the next several years. An indexed universal life or IUL solution is something that can help shield you from taxes. One of the biggest expenses is healthcare. Because people are living longer, that means they're going to have more health issues later on in life. Most people assume that Medicare will pay for long-term care costs. But Medicare only pays for 100 days of long-term care costs. For the first 20 days, Medicare pays 100% of the cost. For days 21 through 100, you pay a $176 daily copayment, as of November 2020, and Medicare pays any balance. After those 100 days are up, how will you pay for it and where will the money come from? Chronic and critical illnesses can definitely jeopardize one's retirement income and the spending that they have for retirement. Last but not least, there's spending. Think about it. Will your spending habits suddenly change in retirement? Spending for that boat, or that big fancy car, or 2 or 3 extra cars now, instead of waiting until retirement. How can we negate that risk? These are some of the main risks in retirement. We want to cover those risks with retirement income and other retirement vehicles. I have a pyramid here that goes over retirement expenses and needs. We have the biggest block showing the essential needs. And these are food, transportation, rent, mortgage on that vacation house, and let's not forget taxes. We would like to see those expenses covered with guaranteed income sources. Guaranteed sources such as Social Security, pensions, which fewer and fewer Americans have, and a fixed index annuity. We would like to see the annuity or annuities structured so that you can't outlive them and they cover you for life. Having a guaranteed income solution in place, something that's protected against these risks and covers your essential needs, takes the what-ifs out of retirement. Next, let's look at the things that you must have in retirement. Discretionary spending. Discretionary spending could be college funding for the kids. It could be a down payment on a house. It could be a wedding for your daughter. That's covered with discretionary spending. And then there's your legacy. The funds remaining for your beneficiaries. We want retirement income to cover this in a way that's guaranteed and protected. But then we also have these other steps of the pyramid that need to be covered with retirement sources from somewhere. Let's talk about a potential income gap in retirement. We have our essential expenses, that's the bottom step of the pyramid. That's the biggest one. That's what you want guaranteed. You don't have to worry about and have peace of mind that your basics are covered from a guaranteed or protected source. Your essential expenses, $40,000, your guaranteed income, $30,000. That's Social Security, pensions which fewer people have, and an annuity. That difference there of $10,000, that's the gap. That's your retirement income gap that needs to be plugged with something that's guaranteed or protected, so that you can have peace of mind and then use your nest egg. Your 400 series to cover some of your discretionary spending. How do we cover that gap? An IUL can plug that gap and much more. An IUL life insurance policy that's tied to the market, but not in the market, grows tax deferred. You can take out funds, tax-free as supplemental retirement income. And you have a death benefit that's tax-free, to be passed on to your beneficiaries. The IUL can cover this gap and other steps of the pyramid. We're going to use that IUL to cover that $10,000, but also your discretionary spending, paying for that boat or that extra car. You can use supplemental retirement income from your IUL to cover that. Your legacy, what you're leaving behind beneficiaries, your kids, your grandkids, your alma mater, favorite charity. When you pass away, an IUL is passed on tax-free. An IUL can cover the gap. It can address discretionary spending and also legacy needs. An IUL can cover all those different attributes. We've shifted the paradigm from having a nest egg to having retirement income cover your essential needs, such as expenses, food, mortgage, transportation, and taxes. These are the risks to retirement, and there are many. But these are the main risks. An IUL can cover the gap needed in retirement. If you have a gap, but it can also cover discretionary and legacy funding. One last key here. Healthcare. We've talked about critical and chronic illness. An IUL can be used to cover some of those expenses as well. An accelerated portion of your death benefit is accelerated to cover some of those illnesses. When you compare your other tax-deferred accounts to an IUL, how tax-efficient is your retirement portfolio? Successful business owners and clients who are maxing out their IRAs and employer-sponsored plans should think about diversifying to gain tax advantages now and in retirement. An IUL is an asset that can give you tax-deferred growth opportunities and retirement distributions that are income tax-free. There are no contribution limitations. No tax penalties for distributions taken before age 59.5, like with a 401k. And no required minimum distributions. Diversifying assets in your retirement portfolio is always a smart way to reach long-term income goals. It's important to select assets that will reduce tax risk as your savings grow and when you take retirement income. The following chart focuses on the tax treatment of the types of assets that may be in your retirement portfolio. All of these have a variety of advantages, limitations, and restrictions. What assets are in your retirement portfolio? Investments in the taxable category are subject to income or capital gains taxes. These recurring taxes can slow growth compared to tax-deferred investments that grow and are taxed later. Investments in the tax-deferred category become taxable when income distributions are taken. These withdrawals can have an impact on tax brackets and modified adjusted gross income. Investments in the tax-favored category are income tax-free. Withdrawals taken from these assets won't affect tax brackets, modified adjusted gross income, taxes on Social Security benefits or Medicare premiums. To recap, advantages include: no income ceilings or contribution limits, no required minimum distributions to take, which retirees will have to take starting at age 72 from tax-deferred accounts, no 10% penalty for early retirement distributions taken before age 59.5, premium flexibility, and distributions can be taken when you want. Can you use an IUL to bridge the retirement income gap? First, you need to find out if you have a gap. The answer is absolutely. IUL can be used to cover the gap and so much more. And that's where JenniferLangFinancialServices.com comes in. We help individuals, families, and small business owners every day put together tax-deferred and tax-free solutions. Keep the IRS out of your retirement. Contact us today to find out if you have a retirement gap and then also if an IUL or tax-deferred annuity is right for you. Thank you for watching. Stay safe.